FedEx just closed its 2026 fiscal year, and on the surface, it looks like a clean win. Revenue climbed almost 8% to nearly $95 billion, and operating cash flow jumped more than a quarter to just under $9 billion. But underneath sits a quieter story most viewers miss: a second straight year of margin erosion, and a balance sheet suddenly filled with cash funded by fresh debt. We work only from FedEx's own filings, the 10K, the segment data, the cash flow statement, building the real picture: where the growth came from, whether the profit is backed by cash, and which single metric decides whether this momentum lasts. No price talk, no predictions, just the business and the report. Let's get into it. First, the basis. FedEx runs on a fiscal year ending the 31st of May, so these figures cover the full 12 months through May 2026, with every comparison against the same full year earlier. It's an annual filing, so the balance sheet changes are both since the fiscal year start and year over year. They line up. FedEx is a physical logistics business: planes, trucks, sorting hubs, an asset-heavy network moving packages across the United States and the world. That matters because it carries heavy depreciation, which is exactly why cash flow runs so far ahead of reported profit. Diluted earnings per share reached $18.55, up more than 10%, a double-digit line already hinting that something below net income is doing extra work. Here's the scorecard. Revenue rose 7.7% to $94.7 billion, a real reacceleration after a flat prior year. Net income grew 8.3% to $4.4 billion, and diluted earnings per share rose 10.4% to $18.55. So far, so strong. But look at the middle line. Operating income grew only 4.7%, barely half the pace of revenue. When costs grow faster than sales, that's negative operating leverage, the first crack in the story. Net income and EPS outgrew operating profit for two reasons. A modest below-the-line gain and a lower tax bill lifted net income, and a shrinking share count amplified the per-share figure. Genuine growth, but mixed quality, which the next slides unpack. This part separates a healthy result from an accounting mirage. FedEx generated $8.9 billion of operating cash flow, about 2 times reported net income, a conversion ratio near 200%. Better still, that cash flow grew almost 27%, more than 3 times the pace of net income. When cash grows faster than profit, earnings are backed by real money, not accruals or paper gains. Much of the gap is depreciation and amortization, nearly $4.4 billion, the non-cash charge on all those aircraft and trucks that reduces profit but never leaves the bank. Bottom line, on the cash quality test, FedEx passes comfortably. The profit is real, making the margin problem we're about to examine a question of profitability, not honesty. FedEx splits revenue by geography, and the picture is reassuringly broad. The United States is the engine, nearly $68 billion, about 72% of the total, growing fastest at 8%. The rest of the world added just under $27 billion, up 7.1%. What stands out is what's missing. No weak link. Both regions advanced at similar mid to high single-digit rates, so this isn't growth propped up by one hot market while everything else sags. It's also organic, driven by demand and volume, not an acquisition bolted on to flatter the numbers. That breadth is a genuine strength. The catch: all this top-line health still translated into only 4.7% operating income growth, pointing squarely at costs and mix rather than demand. Zoom out across the 3 reported years and the tension becomes obvious. Revenue was basically flat for a year, around 87.7, then 87.9 billion, before this year's jump to 94.7. Demand clearly turned back up. But watch the operating margin over the same stretch. 6.3%, then 5.9, now 5.8. 2 consecutive years of erosion, half a point of profitability quietly given up even as sales recovered. Operating cash flow tells its own story. 8.3 billion, dipping to 7, then rebounding to nearly 9 this year. The cash engine is intact and improving. The message is consistent. FedEx can grow the top line and generate cash, but hasn't defended its margin. Volume is winning. Efficiency is slipping. Let's walk a dollar of revenue to the bottom line. Operating income landed at $5.46 billion, a margin of 5.8%, down a tenth of a point from last year and half a point below 2 years ago. Then something interesting. Pre-tax income of $5.79 billion sits above operating income by roughly $330 million. So there was a net gain below the operating line. Non-operating items helped rather than hurt. Tax took about 23.5%, roughly stable with last year, leaving net income of $4.43 billion and a net margin of 4.7%, flat year over year. The bridge tells you this. The operating layer is where the pressure lives. The tax line and a below-the-line gain kept net margin from slipping further. The problem is operational, not fiscal. Now, follow the cash. Nearly $9 billion came in from operations. Investing outflows, capital going back into the network, narrowed to $3.9 billion, a touch lower than last year, so the company spent slightly less on assets even as demand recovered. On capital returns, the shift is striking. Dividends edged up to $1.37 billion, a steady, growing payout. But buybacks were slashed from just over $3 billion last year to under $800 million this year, a major step down in repurchases. Yet the diluted share count still fell, from 251 million 2 years ago to 239 million now, part of why per-share earnings outran net income. So the profit is cash-backed and the dividend secure, but management clearly redirected repurchase money elsewhere. The next slide shows where. Here's where that redirected capital went, and where the year's biggest number lives. Cash and equivalents more than doubled since the fiscal year start, from $5.5 billion to $13.3 billion, a nearly $8 billion build. But it wasn't all self-funded. Long-term debt rose about $4.1 billion to over $23 billion, and financing cash flow swung from an outflow to a positive inflow of $2.7 billion. So FedEx raised fresh long-dated debt and stockpiled cash. Importantly, leverage stayed stable. Debt to equity held at 2.13 times, barely changed, and liquidity improved. The current ratio rose to 1.48 from 1.19. This is balance sheet repositioning, not distress. The company deliberately preloaded cash, and the next slide reveals what it's earmarked for. 2 signals to close out the numbers. First, insiders. There were 0 open market purchases and 0 open market sales during the period. The only recorded transactions were routine equity grants to 3 officers, identical share counts at a 0 exercise price. That's compensation, not conviction, so read no directional signal either way. Second, far more telling, is what FedEx is doing with that cash. In June 2026, it launched cash tender offers to buy back up to $4.15 billion of its long-dated and medium-term notes across 19 series. And by early July, holders had already tendered significant portions of several notes maturing decades out. Suddenly, the $8 billion cash build and the fresh debt make sense. This is active liability management, retiring long-dated obligations, not a business operating event. It's the dominant catalyst in the filing. So what should you track from here? 3 things. First and most important, the operating margin. It's fallen 2 years running to 5.8%, the single metric deciding whether this recovery is durable or hollow. If cost actions stabilize it, the picture strengthens. If it keeps sliding, revenue growth is just treading water. Second, returns on capital are drifting the same way. Return on equity eased to 14%, down from 14.6 and 15.7 in the 2 prior years, and return on assets slipped to 4.5%, a multi-year downtrend in how efficiently FedEx turns its huge asset base into profit. Third, capital allocation. With $13 billion in cash and a $4 billion tender underway, the question is whether management leans toward deleveraging or brings buybacks back. And watch whether that cash flow surge sustains or partly reflects working capital timing. Let's bring it together. FedEx delivered a genuinely stronger year. Revenue re-accelerated to nearly $95 billion. Growth was broad across both the US and international, and earnings are firmly cash-backed, with operating cash flow running at roughly 2 times net income. The balance sheet is a source of strength, with a large cash cushion and stable leverage, and the year's headline event is disciplined liability management through that multi-billion-dollar note tender. But the recurring theme running through every layer of this report is that the progress is top-line led, not margin-led. Operating profitability has now eroded for a second straight year, and returns on capital are drifting down with it. So the single takeaway: FedEx's cash generation and per-share growth are running ahead of a slowly compressing margin, and profitability quality more than anything will tell you whether this momentum is built to last. Thanks for watching my stock analysis.